There have been many headlines saying no more taxes on Social Security now that this new bill has been passed. But is this really true? In this video, I'm going to break down what Trump's one big beautiful bill, which was signed on July 4, 2025, what it really does and what it doesn't do, and what it actually means for your Social Security benefits. And I'm also going to show you exactly how to calculate how much of your Social Security benefits are subject to tax and how all this works. So let's unpack the reality of all this so that you don't get misled. So on July 4th, 2025, President Trump signed a sweeping bill. It was called the One Big Beautiful Bill. And one of its most talked about features is a new tax deduction for seniors. And unfortunately, many people got the impression that Social Security would no longer be taxed. So here's the deal. Social Security taxes were not repealed. What the bill did do, however, is a few things. First of all, this new tax bill made permanent the individual income tax cuts from TCJA that were scheduled to sunset after 2025. Now, if they didn't extend this, we would have gone back to the old higher tax rate. So that was one thing. But in addition, they did raise the standard deduction a little bit. So they raised it from $15,000 to $15,750 for individuals, and for married folks from $30,000 to $31,500. And in addition, singles that are 65 and over will still get the additional $2,000 deduction, and married folks will still get an extra $1,600 a piece for a total of $3,200 on top of the standard deduction. And by the way, if you itemize, there were some big changes with the SALT deduction, but I'm not going to get into all of that here in this video. Now, the other big change that the bill introduced, and this is really the area of confusion, was this temporary deduction for people age 65 and older. Now, this applies whether or not you take the standard deduction or if you itemize. So the way that it works is that it's an extra $6,000 for individuals or an extra $12,000 for couples filing jointly if you're both 65 plus. Now, this deduction applies to all income. So it includes the amount of Social Security benefits that are subject to tax. And in a little bit, I'm going to show you very simply how this works. And I will tell you right now, this confuses a lot of people, including even people in my own industry, quite frankly. Now, important to know regarding this deduction is that it does phase out once your income exceeds certain limits. So specifically, the deduction phases out beginning with modified adjusted gross incomes of $75,000 for individuals and $150,000 for married folks filing jointly. Now, it phases out completely at $175,000 for individuals and $250,000 for those married filing jointly. And again, as I mentioned, this is temporary. It's only going to last for a few years as it is set to expire in 2028. Now, of course, changes could be made between now and then, but that's where it stands right now. All right. So are your Social Security benefits subject to tax, right? That's really the big question. So let's take a look at how all this works. To clarify here, I'm only going to talk about federal taxes. I'm not talking about state tax, other than just to say that there's only 9 states that tax Social Security. They're Colorado, Connecticut, Minnesota, Montana, New Mexico, Rhode Island, Utah, Vermont, and West Virginia. And the way that this works at the federal level is that it depends upon what your other income is. So you could pay tax on none of your Social Security benefits, or you could pay tax on up to 85% of your Social Security benefits. Now, what that means is that even if you make, let's say, $1 million a year, $10 million a year, doesn't matter how much you might make, still 15% of your Social Security benefits are tax-free at the federal level. To determine exactly how much of your Social Security benefits are subject to tax, what you need to do is to determine what your provisional income is, or your combined income. So these are the same thing, provisional income and combined income. They mean the same thing. So let's dive in here and take a look, and I'll show you exactly how this works. The way that you determine how much of your Social Security benefits is subject to tax is, again, number one, we need to start by figuring out what our provisional income is. And in order to do that, it's very simple. You just need to add up all of your other income plus 1/2 of your Social Security benefits. And then from there, you're going to have your provisional income number. And then once you have that provisional income number, we then apply it to the thresholds down below, and then we'll be able to see how much of our Social Security benefits are subject to tax. So let's run through a quick example here, and you'll notice this is based upon a married couple filing jointly. Please note that if you file as a single, as an individual, that the concept here still works exactly the same. The only difference is the threshold amounts down below, which we'll get to, okay? So here's how this works conceptually. Let's say that your Social Security benefits are $50,000, and let's say that you withdraw $40,000 from a pre-tax 401k or traditional IRA. And let's just say you don't have any other income. So if this is the case, you've got $90,000 of income, but to determine your provisional income, we need to take half of your Social Security. Social Security was $50,000, so half of that is $25,000. And then we add up all the rest of your income. So we add up the other 40. So 25 plus 40 is $65,000. So that's our provisional income. That the only purpose of calculating that is, again, so that we can then apply that to the thresholds down here below to determine how much of our Social Security is then going to be subject to tax. So the way that it works, you'll see here in the thresholds, on the first $32,000 of provisional income, none of that is subject to tax. So we get a big zero right there. On the amount of provisional income above $32,000 and up to $44,000, 50% of that is going to be subject to tax. We're at $65,000, so we're past this threshold. So there's $12,000, spread there between $32,000 and $44,000. So half of that is $6,000. Okay. Now, this next threshold, this above $44,000, they have $21,000 above that threshold, right? So they're at $65,000. The threshold is $44,000. So again, $21,000 above. So if we took that $21,000 at 85%, you'll see that $17,850 is subject to tax. So when we run this calculation based upon that provisional income, that's how we get right down here below that the total Social Security that is subject to tax is this number, that $23,850. So again, their Social Security was $50,000, but less than half of their Social Security benefits in their case are actually subject to tax. So as a side note, and that's why it's really important to understand this, is that in itself, Social Security at the federal level is not subject to tax. As you can see right there, I removed the 401k withdrawal or IRA withdrawal. All right, and you see it's not subject to tax, but the moment I add other income, that's when it can cause your Social Security benefits to become subject to tax. So that's how it works. That's how you determine how much of your Social Security benefits are subject to tax. So none of that has changed. And in fact, those thresholds that you saw right there, those have not even changed since the 1990s. So what's actually happening is that more and more people are actually having to pay taxes on their Social Security benefits just because of inflation. Just, over time, people's incomes are just, tend to rise. Now, from a planning perspective, some things to think about. There's still that deduction. And by having that deduction, if you qualify, that could certainly help to reduce your overall taxes that you have to pay. But, also from a planning perspective, really, big picture, why does all this matter? If I just kind of scratch the surface just a little bit here, some of the things that you may want to consider or reconsider are, doing Roth conversions, or you might want to reconsider the amount that you may want to convert. Because if you think about it, depending on how much you might convert, this could push you over the phase outs if you weren't already there. So you definitely want to take this into account. Another thing, just to kind of think about, again, these are just some high level things, but you may also want to consider making deductible contributions to retirement accounts if you aren't already, or maybe increasing those perhaps. Or maybe contributing to an HSA, right, in a health savings account, or perhaps doing QCDs, which are qualified charitable distributions, which can help reduce income to help qualify for the deduction, all these things, right? So And of course, all of this depends upon your overall income and overall financial situation and everything else. The bill itself didn't change how Social Security income is calculated or how it's taxed. It just introduced a new deduction on top for those that are 65 and over. And the deduction is income limited, and it is temporary. And many retirees already paid no tax on Social Security before this law. So for them, it's really not going to make much of a difference. And if you're still working, or if you're taking large IRA withdrawals, or whatever the situation might be, you just have higher income, then your income just may be too high for you to qualify. The change here is really going to be most helpful for retirees that are in that middle income range, that have enough income to owe some tax, but not too much where you're going to lose the deduction. The key here is just knowing where your income stands and how to plan withdrawals and what changes, if any, that you may need to make before the deduction expires. So if you want help with all this, if you want help planning for a happy and successful retirement, I've added a link below to learn more and schedule a free retirement strategy call. Thanks again for watching, and I'll see you next time.